Are the signs of a weakening economy finally here? And as the Fed was once slow in raising interest rates, are they yet again slow in lowering them to keep the economy afloat? We'll look to answer that question as it relates to FedEx's Q1 report, which came out after the bell on Thursday, sending shares of this one down nearly 15.5% on Friday. We'll get into FedEx's Q1 print. We'll also take a look at the all-important guidance that this company provided for the remaining fiscal 2025, the remaining 3 quarters. We'll also take a look at the upcoming quarters and see really whether or not FedEx can come in and post the numbers that Wall Street has in anticipation for this company. We'll take a look at the margins over at FedEx continue to slip from 7.1% down to now just 5.2%. We'll get into the financials, and then you definitely want to stick around for the technicals, because this is a company that was coming into this print with some pretty high expectations, setting up near all-time highs, and as they fail to deliver not just those expectations but actually exceed them, yeah, that sends the stock lower by close to 15%. We'll highlight some levels where it might make sense for you to step in and pick up shares of FedEx Corporation. Hey guys, hope you're doing well out there. It's time to check in with shares of FedEx, ticker symbol FDX. This was the first stock that I actually covered on this channel, I believe in 2023. The first video on this channel is on FedEx, so if you want to go back and check that out, it's been over a year, but since then shares have done relatively not too much. Actually, year to date you're up just 0.66%. Coming into this print, you were actually at least keeping up with the S&P 500, roughly up around 16-17%. You gave up all of those gains in one trading day. So we'll take a look at whether or not this decline was an overreaction, perhaps maybe a buying opportunity with shares of FedEx. Now keep in mind, you do get a forward yield close to 2.17% with this. At the time of this video, you're also looking at this stock trading right around a 13 times a forward earnings multiple, so relatively inexpensive, but I do say relatively because the growth rates on this company, yeah, they're simply non-existent, so you're not necessarily paying a huge multiple on it regardless. Now, Q1 revenues, this is for fiscal 2025, came in at $21.6 billion, while $21.6 billion is a lot of money. That for FedEx is actually a year-over-year decline of nearly 0.5% on their top line. What's even worse is Wall Street was anticipating basically flat to slight growth on their top line, and so FedEx coming in with nearly a $300 million miss on that top line. Along with that, they came in with an even bigger miss on their bottom line, as non-GAAP EPS came in at $3.60. Estimates were closer to $4.77, so that's a pretty big miss on the bottom line. Now, what that miss also is telling us is FedEx is revising their fiscal 2025 revenue and earnings forecast now to be lower. So in terms of revenue, they anticipate low single-digit % growth on a year-over-year basis. Previous guide was for low to mid single-digit % increase. So probably just 1 or 2% lower on that revenue guide is what FedEx is anticipating. Now, as we look ahead for the next couple of quarters, look, a couple of percentage in revenue growth certainly is impactful over at FedEx, because that could mean the difference between maybe $22 billion, maybe $22.3 billion up to, call it, $23 billion. So a couple percentage revenue growth certainly does affect this company, especially when we get over to their margins. This company is basically on very razor thin margins, so any additional revenue is certainly impactful over at FedEx. And so the slowdown in the revenue growth rates is one of your indicators that the economy is weakening. FedEx certainly is a pretty good indicator on how the economy is doing. It's a pretty good recession indicator, I would say, because they deal with the movement and shipping of physical goods across not just the US, but I'd say a lot of North America. Yeah, they have a pretty good insight into how really they see the economy panning out over the next couple of quarters. And so whenever they revise their revenue guidance to come in a bit slower than when they initially anticipated, yeah, that is an indicator that they're perhaps seeing the economy weakening over the next couple of quarters, something they previously didn't fully anticipate. Now, on top of that, they also revised their EPS guide to be now in the range of $17.90 up to $18.90. Previous guide was from $18.25 up to $20.25. So they're really bringing in the top end of that EPS guide from $20.25 now down to basically underneath $19 from an earnings per share. Similarly, if you take out those cost initiatives that this company has in plan, the high end of the EPS guide coming down from $22 now down to $21. So one thing that is concerning, in my opinion, is the fact that this company did miss by a large margin on their Q1 earnings, missing by nearly $1.20, yet they're only revising their full year EPS down by roughly $1 to $1.30. So despite a huge miss on the Q1, they're not really revising their full year EPS as low as probably I would anticipate because of that Q1 miss. So that brings into questions the upcoming quarters for FedEx. Can they hit the anticipated $4 11 cents in the upcoming Q2. Moving on, can they hit nearly $5 in Q3 and then nearly $6.90 in Q4? Some analysts anticipate an EPS figure as high as $7.90. So I think as an investor, when I see a company miss on their Q1 EPS expectations by a large margin and then not really revise down their full year EPS nearly as much as I would anticipate, that brings into question the upcoming quarters over at FedEx. Certainly has me wondering whether they can come in and post these EPS figures that they anticipate. In case they don't, in case they come in with a Q2 figure underneath maybe $4 and then a Q3 figure underneath $4.50 and then maybe a Q4 figure underneath $6. Certainly if the economy weakens a little bit further than what they currently anticipate, yeah, that's not going to be a good sign for FedEx, because especially management is not expecting that. And so if they come in with maybe one or two more misses, they might have to revise the full year guide down maybe as low as $17, if not $16 a share. And at that point, your forward earnings yield certainly doesn't look as attractive as it currently does, and your earnings multiple goes up just a little bit. So I think that's one cause for concern. One red flag that you should keep an eye on with FedEx is if they continue to maybe post one or two more misses before things really turn in the right direction for this company. I do anticipate them to lower the full year EPS guide, once again probably putting selling pressure on shares of FedEx. Now, along with the EPS and revenue guidance we got, they did reaffirm their forecast of the permanent cost reductions from the Drive transformation program of nearly $2.2 billion. And then they also expect capital spending to be roughly $5.2 billion. And a majority of that being on the optimization and efficiency improvement, including fleet and facility modernization and automation. So we got some good things that FedEx is reaffirming. They're doubling down on their permanent cost reductions of nearly $2.2 billion. The one thing that I am really concerned about is if this company once again comes in, misses an EPS, and then once again lowers their full year EPS guidance, that could continue to put some pressure on this stock that is trading at a relatively inexpensive valuation at the current time, right around 13 times. I think that's right around fair for this company to trade at this valuation. What I don't like is the fact that there's not a whole lot of safety baked into this name at the current time. Certainly underneath a 10 times earning multiple, you have a bit more safety baked in that in case the economy continues to weaken further, yeah, FedEx's valuation won't look overly egregious at that point. Now, coming into this print, certainly the expectations were high for FedEx as they were in the green for nearly 8 straight sessions. And when we get over to the technicals, you'll see this one was basically coming in near all-time highs. And so, yeah, no doubt you see a large reaction in these shares, especially when they come in with a miss and a lowered EPS and revenue guidance. Now, in terms of the margins, we talked about this at the top. Your operating margins are slipping from 7.1% down to 5.2%. There's two main reasons for that. The first is they're really not able to grow their revenues, and especially the higher margin revenue. So US Priority, which is again a higher margin revenue over at FedEx, that's sort of the express shipping that customers are willing to pay a bit more for in order to send and receive packages on a faster timeline. So revenues there slipping nearly 3%. The US deferred business, which again is a slightly lower margin business, not as time sensitive for their customers, once again slipping by nearly 3%. And then international priority, once again also slipping by close to 5%. They are seeing some benefits on the international economy side, as that is up nearly 22% year over year. But all things considered, your total package revenue declining nearly 1%. So when you're not able to grow your top line, it's going to be very difficult to maintain your operating margins, especially for a company like FedEx, because take a look at this. Your operating expenses don't really have a whole lot of room to be revised lower. You still have to continue to pay your salaries and employees their benefits because, yeah, they simply won't work for free. On top of that, you probably have some competition with companies like Amazon trying to poach some of FedEx's workers, at least on that warehouse side, as Amazon is a company that's probably willing to pay their workers a bit more in order to put more pressure on companies like FedEx. You also continue to have your purchased transportation costs as they have to continue to upgrade that fleet and basically upgrade their planes and trucks. You then have a large amount of depreciation and amortization on that fleet. You also still have your fuel expense, which staying relatively flat, down just 1% year over year as fuel prices continue to stay at the same level basically since a year ago. And then you also have your maintenance and repairs on your large fleet. So while you're not able to control your operating expenses by ticking them lower and your revenues continue to slide down, yeah, that will no doubt put a pressure on your operating margins, once again coming down 190 basis points year over year. So keep that in mind. This company, as the economy weakens, their margins will continue to deteriorate. And look, 5.2% operating margins, not a great business, especially when you have a ton of competition from UPS, from USPS, and of course, not to mention Amazon themselves. And then on top of that, you really don't have a whole lot of room to drive your operating expenses lower because, yeah, a lot of these costs are fixed and really run the business on its own. So you don't have a whole lot of room to move those operating expenses too much lower. Now, like we saw, total revenues being roughly flat down to roughly $21.5 billion. Your operating expenses not able to control those nearly as well. And so your total operating expenses actually ticking up, hurting your operating income, now down to $1.1 billion. Last year, you were closer to $1.5 billion. On top of that, this company continues to pay interest on a pretty large amount of debt. As we get down to the balance sheet, we'll take a look at that. And so your total net income declining nearly 26% year over year. Again, a surprising miss compared to what Wall Street anticipated. Now, the good thing is this company is continuing to buy back their shares. You see 3% reduction in shares outstanding. That's on a year over year basis. And then the other thing to note is they do list out their capex here as $767 million. Keep in mind that is down 41% year over year. When we get down to the cash flows, you see despite the fact that your capex is nearly 41% lower than it was a year ago, you're generating far less free cash flow. And look, for a company like FedEx, free cash flow really dictates how this stock will perform, because anytime you have large amounts of free cash flow, you're able to pay off that dividend, continue to raise that dividend. On top of that, you're able to do buybacks, you're able to continue to invest in modernizing that fleet of trucks and planes. But anytime your free cash flow really suffers, this company is having to dig into their balance sheet to continue to operate the business. So we see $1.2 billion in operating cash flows, significantly down from last year where you were closer to $2.2 billion. Again, reducing your capex, that's still not enough, because this company generating right around $300 million of free cash flow in this most recent quarter compared to last year where they were closer to, I'd say, $1 billion in free cash flow. And so what they were able to do with that nearly $1 billion in free cash flow last year is they bought back close to $500 million in their common stock. They also paid off nearly $300 million in dividends, paid off some debt, and they still had nearly $200 million to add on to their balance sheet. This was last year. This year, generating just around $300 million in free cash flow doesn't give them a whole lot of room to do much with that. In fact, basically spent all of that on their dividend because they continue to have to pay that dividend. On top of that, they did a nearly $1 billion buyback of their common stock. And yeah, they did pay off some debt, but not as much as they really probably could have at the same time last year. And so they had to dig into their balance sheet, dig into that cash pile, paid out nearly $600 million in terms of investing activities from their cash pile. And so when we take a look at the balance sheet, you see over the last 9 months, cash declined from 6.5 billion down to 5.9 billion. So that really tells you, in order to just continue to operate FedEx as a business, yeah, the free cash flow really is what dictates how this business goes. Anytime free cash flow dips, I'd say below that $1 billion mark, that is tough for this business because they continue to have to pay that dividend. They should be able to do buybacks. And then they also have a fair amount of debt that they need to continue to repay. In fact, taking a look at debt, nearly 600 million in short-term debt. On top of that, you have close to 20 billion in long-term debt. So yeah, that debt certainly continues to add on to the interest. Now, as interest rates begin to drop, that should bode well for this business, not just because the interest payments on that debt will begin to be lowered, but also lower interest rates generally tend to help out the economy, which in turn should help out FedEx themselves. So a couple things to keep in mind. First of all is the margin story. This company certainly doesn't have a whole lot of room to reduce those operating expenses. So the revenue growth is very, very meaningful over at FedEx. And so anytime they're guiding for lower growth on the revenue side, even just by a couple percentage points, that's something to be concerned about. Also, the fact that this company not really revising their EPS guide as low as maybe I would have thought has me a bit concerned about the next couple of quarters, wondering whether FedEx can come in and really hit those estimates that Wall Street has for this company. From a technical perspective, though, you have a slightly different story as you saw that nearly 15% drawdown in the stock. You're coming close to a level of support right here at $247 a share. Might even want to bump this up slightly to basically be at $250 a share. You've seen some levels of support, also some levels of resistance in the past at that level. So certainly that's a point where you could look to maybe step into shares of FedEx if you have no position. The other thing that you could maybe support this stock is with an uptrending trend line similar to this, because you are to some extent making a pattern of higher highs and higher lows. Not overly convincing, simply because this trend has only been intact for right about 9 months, so you don't have a whole lot of data points, but you could certainly make the case that this company could see a rebound right around from this $250 range. So look, if you are eager to step into shares of FedEx, this $250 range certainly is proving to be support, not just from one, but actually 2 technical points. So you could maybe look to step in, at least from a swing trading perspective, at this point, and look to maybe play a rise in shares of FedEx all the way back up to this $300 range. If you do that, I would probably set a stop loss right here at maybe $240. So you're maybe risking $10 to the downside to make another, call it $50 to the upside. That's a pretty good risk reward trade in my opinion. So that from a trading perspective, I think you have some opportunities with FedEx, believe it or not. But from a buy and hold long perspective, I would be a bit more cautious at the current point, not just because of this huge nearly 15% decline, because you will have some sort of sellers step in as shares of FedEx continue to move higher. But I think from a fundamental perspective, I think closer to this $200 range, really where this area of support from $200 up to $216 is, that is actually a point where I would be far more aggressive in owning shares of FedEx, because I think at that point you have a bit more safety built into the stock. Probably will take a couple more misses and a bit more of a EPS revised lower for shares to come down to this point. But I think at that point, your valuation is probably closer to 10 times in earnings multiple. I think, again, a bit more safety is baked into the stock. You also have some long-term support back from 2022 at that point. So certainly at this $250 range, you could maybe look to incrementally step in, probably hoping for a reversal higher up to this $300 range. Me personally, I'm not eager to jump in at this point. I would wait for the next couple of quarters to see how this stock really plays out, also how the economy really plays out, because like we said, FedEx is extremely dependent on the economy, and as the Fed was once slow to raise interest rates, they might just be slow in lowering interest rates once again, which will probably take into effect maybe somewhere around 12 to 16 months from now. But until then, shares of FedEx might certainly continue to feel the heat, simply because their revenues and earnings aren't going to be in a great position. So that was my take on shares of FedEx. One I think you should be a bit more cautious on. Don't just take the low valuation or the relatively low valuation on its face. Dig into the details a little bit more. Take a look at the earnings report. Take a look at the comments made by management on their conference call. You'd be a bit more concerned about the economy, I think, as you do that. And anytime the economy is looking to be a bit more weak over the next, call it, year, I think shares of FedEx can also maybe underperform over that time period. So I would be a bit more cautious when it comes to FedEx in the next, call it, 12 to 16 months. But I think over the long term, you still have a pretty good business where you can get a dividend. You can also maybe get a little bit of capital appreciation on this side. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.